The standout worst performer on the JSE Securities Exchange at the moment is African Bank Investments Limited. That's after its results were released earlier today. Don't forget we were flagged about this company with its trading update a few weeks ago. The share price then got clobbered by about 15%. It's sort of drifted lower since then. Today, another massive hit. Is it justified? What are these numbers all about? Do they bode ill for the rest of the sector? Lots of questions. On the line now is Janine van Zyl, analyst at Old Mutual Investment Group South Africa, OMIGSA. Janine, what did you make of the numbers first of all? Are they as bad as the market is suggesting?
Lindsay, I'm a little bit surprised by the share price because we had most of this information a few weeks ago. We already knew most of the reasons for the yield decline, the bad debts. So I'm a bit surprised that the share price has taken such a knock. I don't really know what the market's seeing other than maybe a concern about a capital raising, although I don't really see that as necessary at this stage.
Now, there is a rumour that's been in the market. Of course, if they maintain a dividend, they must be fairly confident that they will not have to have a rights issue. But it's certainly a rumour doing the rounds. And as I said earlier on to a commentator, there's been the perfect storm. There's been the trading update. There's been the unsecured loan talk that's been going on for so long now. There's been regulatory issues that people are worried about. And also some people in America saying fairly unpleasant things about the model, not just African Bank's model, but also some of the bigger banks and also some of their competitors. So it was inevitable, but for a big share, this is a big move.
Yes, it's an enormous move, and really this share is now trading at its net asset value, and I think after today possibly even below its net asset value, which doesn't seem reasonable for a company that's still giving us a ROE of, well, the bank's giving us a ROE of 16%, and that's higher than most of our other big listed banks, you know, even though it's a big drop from where they came from of the 22%. So it's really difficult for me to understand why it's trading quite here, but I think it's just an overreaction as shareholders often do.
Yes, indeed. Too much to the upside, too much to the downside, I think, in this case. 13.9% is the overall ROE there. That's including Ellerines. Well, it's still quite a smackdown from what was it in first half of 2012, 20.3. And I suppose the anticipation is that it could go lower. And I just wonder if Ellerines, the situation with Ellerines is one of the bigger drags on it as well, because it's almost swinging into a loss.
It's possible, and it's very likely it will make a loss in the second half of the year, because the second half for Ellerines is always a weaker half with no Christmas in. But really, Ellerines is a small part of the big business, and you know it's almost been written down to nothing so far. So it still really doesn't explain the bad sentiment, although I think it just is a sentiment. And there's a lot of bad news out of Ellerines. I would read through quite badly into the whole furniture industry. But I still don't quite get why the valuation of the whole company has been written down so badly.
I think it's just a knee-jerk reaction and stop losses going and momentum traders and high-frequency traders doing their thing. Janine, personally, I think it will bounce back. Whether it can go up again, I don't know. I like the way they put their challenges. They're very good and honest about the way they conduct themselves, ABIL. Challenges listed as subdued economic outlook, slowing consumer demand, tough collections environment, regulatory uncertainty, growing the customer base, etc., etc. So they're not pretending that the garden is rosy.
No, they're not, and I think they are very honest. I mean, the fact that they came a little bit late in telling the market is probably what really worried the market about this. If they only know in March what's really going to happen, then how are we expected to know? That's sort of, I think, the view that the market is taking out there, that how can these surprises come so quickly? But there are some of the issues that things are changing quite quickly in South Africa. Regulations changing very quickly. The prospects about the insurance income is changing quite quickly as people start to understand maybe what the regulator is going to want from them. And that's obviously changed how they realize their yield and on their insurance book. And yeah, there's just so much changing so quickly. And then on top of that, the consumer continues to change. So it did seem like it came a bit suddenly, but you know, maybe they're just working in a very difficult environment.
Janine, of course, it's probably too late to sell African Bank now because it's down 24% as we speak, 23.65% to be precise. Capitec, of course, has come down, but not by nearly as much. What about the big banks, though? What about something like Absa, which I said to Sasha Narishkin, our markets commentator, earlier on? They've got the Edgar's book. Are they vulnerable?
They are, but it's so much a smaller part of their business. And I think that also the whole mix, of course, they don't have the Ellerines side effect that ABIL has had. And then on top of that, the unsecured lending book of any one of the big banks is still a very small portion of the overall book, because they really are mortgage lenders. They have been encroaching into that side of the business, but it really isn't the primary business. And that's really always the risk of ABIL and Capitec to a degree, is that it's a one product bank. So if that product falls down, then we have a problem. And the others are way more diversified. But I don't think that our banks have been totally disaffected by this. I think they actually, the shares have taken some pressure because of the unsecured.